Hey, puppy trades! Mic check 1 2 1 2. I hope I sound good. We have an important tutorial in this video: how to make 41% annualized return with a 45% dividend yield. Yes, more than 3 times the average annual return of the S&P 500 and more than 40 times the current dividend yield. So training these AI models to help with portfolio analysis, how is it done? The first thing to do is make sure that CHAT-GPT has the right ETF. So I said look up RDTE ETF and SRTY ETF, and I made sure it got the right ones. The Roundhill Small Cap 0 DTE Covered Call Strategy ETF is an actively managed fund that provides overnight exposure to the small cap index. Each morning, it seeks to generate income by selling out of the money 0 days to expiration call options on the small cap index. The fund aims to pay weekly distributions to shareholders. As of January 27th, 2029, RDTE is trading at 40.95, down 1.015% from the previous close. And then it told me that it had the right ProShares SRTY ETF designed to deliver more than 3 times the inverse of the daily performance of the Russell 2000 index. So I started with this first, and I said, what happens if an investor buys 67% RDTE and 33% SRTY and reinvests in this pair forever? And it wasn't too positive. It said investing 67% in RDTE and 33% in SRTY and reinvesting indefinitely could lead to an unusual portfolio because these ETFs have distinct characteristics that could produce mixed long-term results. So it actually said no. Not a great idea. Understanding the ETFs, RDTE and SRTY, what happens over time, performance divergence. RDTE's relatively stable income-focused approach contrasts with SRTY's highly volatile and decay-prone strategy. In most scenarios, SRTY is expected to erode in value over time unless the market consistently declines. Rebalancing challenges, mixed exposure, and the compounding effects of decay. So it said no. Key risk: volatility decay, market conditions, income versus the growth trade-off, not looking good. So likely outcome: over the long term, the portfolio is highly likely to underperform a simpler strategy of holding the underlying small cap index or a traditional balanced portfolio. RDTE's covered call strategy may generate income and offset some losses from SRTY, but the combination is unlikely to yield substantial growth due to the drag from SRTY's inverse leverage structure. So alternative strategies, give me alternatives. If you're considering exploring unique portfolios with consistent reinvestment, consider allocating more to RDTY and using SRTY sparingly. Replace SRTY with a less risky hedging tool. Focus on more diversified income or growth strategies that may align with my investment horizon and risk tolerance. I said, what would a better allocation be? It said a better allocation depends on your investment goals, risk tolerance, and market outlook. Since RDTE focuses on income with limited upside, and SRTY is a leveraged inverse ETF with high risk and decay, a more balanced allocation might involve reducing exposure to SRTY or replacing it entirely. Here's the suggestion based on typical investor objectives. For long-term income with risk mitigation, 80 to 90% RDTE would be better than what I proposed, and 10 to 20% SRTY would be a tactical hedge to protect against significant short-term market declines. Rebalance periodically to prevent it from becoming too small or too large. Why? This allocation prioritizes income while keeping SRTY as a minor hedge against downside risk. RDTE's income should compensate for some of the losses from SRTY's decay over time. And so it gave me another cool option for moderate growth and downside protection: 60% RDTE, 20% a less volatile inverse ETF or a short-term bond ETF, for example SH or BIL, And for equities, to add a growth-focused small cap or broad market ETF, IWM or SPY. Why? This allocation reduces dependence on leveraged products and balances income, growth, and protection. The equity exposure offsets the limited upside of RDTE, while bonds or inverse ETFs cushion against downturns. For aggressive traders, it said I could do RDTE 50%, and then 20 to 30% a larger allocation to exploit bearish opportunities if I have the option to actively monitor markets, and then 20 to 30% cash or short-term bonds, preserve dry powder for rebalancing or market opportunities. Very interesting. So we kept looking at portfolio alternatives. It suggested I use SH and RWM to have less leverage involved. And I said, what about TWM? It has less decay, but it has, it has less decay. So I said, what would the optimal allocation be? And it said switching to TWM instead of SRTY reduces the impact of volatility decay because TWM uses 2x leverage instead of 3x. This makes it slightly more suitable for a hedging strategy, though it's still best used as a short-term hedge rather than a long-term holding. It said 80 to 85% RDTE, and TWM was 15 to 20%. So I started to get 15 to 20% as the optimal hedge. So going down further and further, TWM has less volatility decay, still not a good long-term idea, and the rebalancing frequency was to reinsure that the portfolio doesn't overexpose me to TWM's risk. If your goal is a less complex hedge, consider reducing leverage further. Replace TWM with RWM, 1x inverse Russell 2000. It has no leverage decay and is suitable for long-term hedging. Adjust allocations accordingly. And I said, what about LFGY, YBTC, and SBIT? I made sure once again that it had the right ETFs. And it said the objectives for each of them. LFGY is an actively managed ETF aiming for current income and capital appreciation by investing in a portfolio of 15 to 30 U.S. listed crypto industry and technology companies. The fund generates income primarily by writing, selling option contracts on some or all of its portfolio companies with the goal of distributing income on a weekly basis. And then YBTC, utilizing a synthetic covered call strategy to provide current income on a weekly basis while offering exposure to the price of Bitcoin. This strategy involves holding positions in Bitcoin and selling call options to generate income, which may result in a capped upside potential. And then I made sure it had SBIT correctly. And I said, create a conservative, income-oriented portfolio with these ETFs using SBIT as a hedge. And what it originally said was 60 to 70% LFGY as my income generator. The reason? LFGY generates income by investing in crypto-related stocks and writing covered calls, which produces consistent weekly distributions. Its focus on crypto-related equities diversifies exposure beyond Bitcoin itself. YBTC, 20 to 30%. Reason? YBTC adds direct exposure while utilizing the covered call strategy to generate income. This ensures weekly cash flow while limiting downside volatility compared to holding Bitcoin outright. 10% SBIT, downside hedge. Reason, SBIT's negative 2x leveraged inverse Bitcoin exposure provides protection during significant Bitcoin price declines, mitigating portfolio losses in bearish crypto markets. So it said the big benefits. It gave me this wonderful looking table. And then what I said is add RDTE and SRTY into this mix. And that's where it really got interesting. I said add RDTE and TWM to this prompt. Here's an updated income maximizing portfolio that now includes LFGY, YBTC, SBIT, RDTE, and TWM. It said LFGY, 35%, core crypto income generator. Why? Provides consistent weekly income by investing in crypto-related equities and writing covered calls. This ETF balances crypto market exposure with a robust income stream. And then RDTE, core income stability. Why? Focused on income through covered call strategies on established U.S. equities, it provides a stable income stream to complement the high volatility of crypto ETFs. 20% YBTC, adds direct exposure to Bitcoin price movement while generating weekly income from covered call options, complements LFGY's equity-based crypto exposure. SBIT 10% and TWM 10%. And then I said, wait a minute. It gave me this wonderful table once again, and it told me the wonderful characteristics: maximize income, adequate downside protection, diversification, and risk mitigation. But I said, wait a minute. Doesn't this portfolio have problems because it is equally hedging Bitcoin and IWM, even though the Russell 2000 is a smaller allocation? And it said yes. Adjusting the hedge allocation to 15% SBIT and 5% TWM makes sense, especially considering the portfolio's crypto tilt. Here's why this makes more sense. Reasoning for 15% SBIT and 5% TWM. Crypto exposure focus. Since the portfolio is heavily tilted toward crypto-related ETFs, LFGY and YBTC, it's important to have a larger hedge for Bitcoin volatility. And so then it gave me this new updated allocation. LFGY 35%, RDTE 25%, 20% YBTC, 15% SBIT, 5% TWM. Impact of this allocation: increased downside protection. The additional 5% allocated to SBIT provides a more robust hedge for Bitcoin, which is the primary risk in crypto-heavy portfolios. Reduced drag from TWM, and a balanced hedge focus. The focus on SBIT helps better protect from crypto-focused portions, while TWM still offers a layer of protection without overloading the portfolio with excessive hedging positions. So I said estimate the dividend growth, and wouldn't the weekly dividends explode? So what it did was it actually just estimated. It estimated based on very low yields. So I had to give it the right yields. The right yields are 40% YBTC, LFGY is 70%, and RDTE is 33%. And I said, now that you've got the right yields, give me the analysis. It was very useful. It said, given the updated higher yield estimates for RDTE, YBTC, and LFGY, we can now recalculate the portfolio's growth with the reinvestment strategy. Here's a breakdown. And it gave me this wonderful table again. I said estimate the growth of the portfolio with the higher yields. And it used this formula. FV is the future value of the investment. P is the principal, 10,000. The annual yield was 40%. The T, time in years. So after 5 years, 10,000 grew to 51,000, and after 10 years, 10,000 grew to 261,000 due to reinvested dividends. I said, would the weekly dividends explode? It said, with these elevated yields, the dividends from LFGY, YBTC, and RDTE would be much more substantial. Since dividends are reinvested, you'll be compounding the earnings more quickly. Here's a breakdown of the potential. Conclusion: with high dividend yields of LFGY 70%, 40% YBTC, and 33% RDTE, this portfolio is designed for explosive growth if dividends are consistently reinvested. The impact on the overall growth of the portfolio is massive, especially over a 5 to 10 year horizon. Would you like me to dive deeper into the potential fluctuations of these high yielding ETFs or the reinvestment schedule? And then I said, what is the total annualized return? And it told me the total annualized return based on the future value, the present value, and T, time in years, with a $10,000 investment, said that the CAGR would be 41.9%. This means my portfolio grows at an annualized rate of 41.9% per year, which is exceptionally high and reflects the reinvestment of dividends and compounding effect. Let me know if you want me to explore this, how this rate compares to other investment strategies or markets. So this was using CHAT-GPT to make an optimal portfolio. I am certainly going to invest in this portfolio. I believe I'm going to do it for the long term, but I'm definitely going to invest in a very similar allocation to this tomorrow.